Have you ever noticed how some of the things we work hardest to afford would be the first things we regret owning if the economy suddenly turned against us? Most people in the United States and across Europe assume that stability is the default setting. Salaries arrive on time, mortgages get paid, credit cards roll over quietly in the background, shops stay open, flights depart as scheduled. It feels permanent. But history suggests something else. Recessions happen, banks fail, industries shrink, jobs disappear faster than we expect. And when that happens, certain purchases that once looked impressive or responsible quickly become financial weight. Let's imagine a realistic scenario. You were 32 years old, living in Chicago, Manchester, or Berlin. You work in marketing or IT, or maybe healthcare administration. After taxes, you bring home $4,200 or euros each month. It feels decent. Not wealthy, but stable. Your rent or mortgage is $1,600. Car payment is $450. Insurance adds another $300. Utilities and internet costs $250. Groceries run about $600. Student loans or credit cards take $400. Subscriptions, gym, streaming services, small lifestyle upgrades add another $300. Before you realize it, $3,900 is already committed. You have $300 left for savings, emergencies, or investing. On paper, everything is fine. You are middle class, you are responsible, you are progressing. Now imagine a sudden economic contraction. Your company cuts hours or lays off 20% of staff. Your income drops by 30% overnight. Instead of $4,200, you bring home $2,900. The problem is not that you were reckless. The problem is that many of your purchases assumed permanent income. The first category that becomes useless during economic collapse is the luxury vehicle financed on credit. In normal times, the $450 monthly car payment feels manageable. Maybe the car cost $45,000 financed over 6 years. With interest, you may pay closer to $52,000. But during an economic shock, that car does not produce income. It does not reduce risk. It only demands payment. If your income drops by $1,300 per month and you still owe $450 plus insurance, fuel, and maintenance, the vehicle becomes a liability that cannot easily be reversed. Selling it in a downturn often means accepting a loss. The market value may be $32,000 while you still owe $38,000. Psychologically, the purchase made sense. Cars signal progress. In both American and European cities, driving something new communicates stability. It rewards years of work. It feels like control. But financially, it locks you into fixed costs when flexibility is what protects you. The second purchase that becomes fragile is an oversized home bought at the edge of affordability. Consider a couple earning a combined $7,000 per month after tax. They purchase a $550,000 home with a mortgage payment of $2,800. It is technically approved by the bank. It stretches them but does not break them. In a stable economy, that seems rational. Real estate historically appreciates. Ownership feels secure. But if one income disappears, the math shifts immediately. A single salary of $3,500 cannot comfortably support a $2,800 mortgage plus utilities and food. Within months, savings drain. The house becomes a source of stress rather than stability. The mistake was not buying property. The mistake was assuming income stability while maximizing leverage. Banks calculate affordability based on current earnings. They do not calculate based on worst-case scenarios. The third purchase that quietly loses value is expensive lifestyle subscription spending layered over credit. Many middle-class households carry $5,000 to $15,000 in revolving credit card balances. At 20% interest, $10,000 in debt costs $2,000 per year in interest alone. Add $300 per month in lifestyle subscriptions and small upgrades, streaming platforms, premium phone plans, high-end gym memberships, meal kits, app services. Individually, none of them feel dangerous. Combined, they create fixed obligations. During an economic collapse, these expenses are the first to feel absurd, yet canceling them does not solve the deeper issue if credit card interest continues compounding. The psychological driver here is normalization. When everyone around you maintains a certain standard of living, it feels modest rather than excessive. We adapt upward quickly. Cutting back feels like losing status. The fourth purchase that becomes vulnerable is speculative investment funded by borrowed money. In strong markets, margin accounts and leveraged property purchases feel intelligent. If markets rise 10%, leverage amplifies gains. But in downturns, leverage works in reverse. A $30,000 margin position can be forced into liquidation if asset prices fall sharply. Property bought with minimal equity can become underwater. People assume markets always recover quickly because in recent decades they often have. But time matters. If you need liquidity during collapse, long long-term recovery is irrelevant. The fifth category is highly specialized luxury goods that cannot easily convert to cash. High-end watches, niche electronics, expensive hobby equipment, designer furniture. In stable times, they symbolize taste and success. In crisis, they become illiquid assets. Selling them often means accepting steep discounts because buyers are scarce. The hidden financial flaw behind all 5 purchases is not irresponsibility. It is concentration of risk. When most of your money flows into fixed commitments tied to income, your margin for error disappears. Let's return to our earlier example. If monthly expenses are $3,900 and income drops to $2,900, you face a $1,000 shortfall each month. Even with $10,000 in savings, that buys only 10 months before difficult decisions appear. Now imagine instead that your fixed obligations were $2,500. The same income shock becomes survivable. Stress remains, but options exist. Financially intelligent individuals think differently during good times. They do not assume collapse is imminent. They assume volatility is normal. Instead of maximizing lifestyle at peak income, they maintain structural flexibility. That might mean driving a reliable used car rather than financing prestige, buying a home below bank approval limits, avoiding high-interest credit entirely, building liquid savings before upgrading lifestyle. The shift is subtle. It is not about fear. It is about optionality. Optionality means you can adjust when conditions change. When the economy contracts, people with low fixed cost experience inconvenience. People with high fixed costs experience crisis. The difference often traces back to purchases made during expansion years. Economic collapse does not make items useless because they stop functioning. It makes them useless because they stop serving your survival and freedom. And that is the uncomfortable realization. Many of the things marketed as markers of success are fragile under pressure. When the economy is strong, most people structure their finances around optimism. They assume income will continue, markets will recover quickly, and expenses will remain manageable. Financially intelligent people do something different. They structure their spending and assets around uncertainty, not confidence, not because they expect disaster, but because they understand that volatility is normal in both the United States and Europe. Let's explore how that structure actually looks in real life. Start with fixed costs. Imagine 2 professionals in their early 30s, each earning $4,500 per month after tax. Person A has fixed monthly obligations of $3,800, rent, car payment, insurance, subscriptions, loan payments, very little flexibility. Person B has fixed costs of $2,600, similar lifestyle quality but fewer long-term commitments. When income drops by 25% during a downturn, both feel pressure, but only one faces immediate instability. Financially intelligent individuals deliberately keep fixed expenses lower than what banks approve and lower than what social norms encourage. They understand that fixed costs are dangerous because they do not adjust when income does. Variable costs can shrink, fixed ones cannot. Housing is usually the largest structural decision. Instead of buying at the top of their borrowing capacity, financially resilient households often keep housing under 25 to 30% of take-home pay, sometimes even lower in uncertain industries. That decision may mean choosing a smaller home or renting longer than peers. During expansion, it can feel conservative. During contraction, it becomes stabilizing. The next structural layer is liquidity. Liquidity means accessible cash or near cash assets that can cover months of expenses without selling long-term investments at a loss. In strong markets, holding cash feels inefficient. If inflation is 3%, idle cash appears to lose value. But in downturns, liquidity protects against forced decisions. If monthly expenses are $2,500 and someone holds $15,000 in accessible savings, that provides 6 months of runway. That runway reduces panic. It prevents reliance on high-interest debt. It allows time to search for new income without desperation. Financially intelligent individuals see liquidity not as lost returns, but as insurance. Now consider debt structure. Not all debt is equal. A low fixed-rate mortgage on affordable housing is structurally different from revolving credit card balances at 20% interest. During downturns, high-interest debt compounds while income may shrink. That creates negative momentum. Resilient households typically avoid consumer debt entirely or eliminate it quickly. quickly. They understand that interest is a fixed obligation that does not care about economic cycles. This reduces fragility. Next is diversification of income and assets. In stable periods, many people rely on a single employer and a single salary. That works until it doesn't. Financially intelligent individuals gradually build alternative income streams where possible. This does not mean unrealistic side hustles or constant grinding. It may mean professional certifications that increase employability, small investment income, part-time consulting, or dividend-producing assets. Even modest diversification reduces dependence on one source. On the asset side, resilience means avoiding excessive concentration. Instead of placing all capital into one property or one speculative stock, they spread exposure across broad markets, asset classes, and geographies. The goal is not maximum short-term gain, it is reduced catastrophic risk. Another key structural element is lifestyle adaptability. Some households build a lifestyle that requires constant high income to maintain. Expensive leases, private schooling at the edge of affordability, luxury financing, frequent discretionary spending embedded as routine. Financially intelligent individuals design lifestyles that can contract without emotional crisis. For example, dining out may be enjoyment, not necessity. Travel may be flexible, not financed. Subscriptions may be conveniences, not permanent commitments. This adaptability matters because downturns are often temporary. A lifestyle that can shrink for 12 months without collapsing is far more stable than one that demands perfection every month. There is also a psychological component. Resilient earners separate identity from consumption. They do not view a financed car, a large home, or visible luxury as proof of success. Their confidence comes from balance sheet strength rather than public signals. This reduces social pressure. When peers upgrade, they evaluate based on structure, not comparison. Let's look at a practical numeric example. Suppose someone earns $5,000 per month after tax. A fragile structure might look like this: $3,500 fixed obligations, $500 discretionary, $1,000 savings. If income drops to $3,500, savings disappear immediately and debt begins. A resilient structure might look like this: $2,400 fixed obligations, $800 discretionary, $1,800 discretionary, $1,800 savings or investment. If income falls to $3,500, discretionary spending can shrink and savings slow, but survival remains intact. The income is identical, the stability is not. Finally, financially intelligent people think in terms of optionality. Optionality means maintaining the ability to choose. Choose to relocate for a better job. Choose to take time off without immediate crisis. Choose to invest during market weakness. Choose to start a business carefully rather than from desperation. Optionality requires low fixed costs, manageable debt, liquidity, and diversified assets. It rarely looks impressive during boom years. It often looks ordinary. But downturns reveal structure. When the economy contracts, people with high leverage and rigid expenses focus on survival. People with resilient structures focus on adjustment. Stability is rarely about predicting collapse. It is about designing finances that do not break easily. Financially intelligent individuals accept that cycles are normal. Instead of building a life that only works in expansion, they build one that functions across conditions.